So welcome to Ratios Comprehensive Problem. So we should start by saying there are many other ratios that could be calculated. So despite this title, it's not a comprehensive list of ratios. And also note for ratios where there's an income statement or a cash flow value that's combined with a balance sheet value, we calculate the average values for the balance sheet figure used. The reasoning can be shown here. So imagine we start the year January 1st, end at 31st, and company A has one machine and buys a second machine. Therefore, it'll end the year with two machines. Company B has two machines from the beginning of the year and doesn't buy a second one. So company B had an average of two machines for the year, but company A actually had an average of 1.5 machines for the year. So if you're looking at volume of production or efficiency, saying they had two machines, because you're looking just at the balance sheet value at the end of the year, would not quite be a fair comparison. So that's why when you have combining values like income statement and cash flow combine is a flow value. So it's in income statements are earned throughout the year, and same goes with cash flows. Together, when you compare them with balance sheet items, which are using just one point in time, normally we tend to use weighted averages of balance sheet items. So here we would have the average of for company A would be 1.5, and the average for B would be 2, which would be more appropriate. So here we have company B and company A as we showed, but let's look at another potential scenario. Company C starts the year with one machine, purchases a machine early in the year, and it ends with two machines. Company D, on the other hand, starts with one machine and buys a second one just before the end of the year. So as you can see, companies A, C, and D would have the same ending and beginning value. So you'd have 1, 1, and 1. And 2, 2, and 2. So the point here is that analysts will calculate a simple average of the balance sheet items, realizing that they are approximation of the true values. So just to keep that in mind. Let's proceed. So here's an example of a company. We're showing the 2019 income statement and the balance sheet for 2018 and 2019. Just want to point out the end of 2018 is like saying the beginning of 2019. So this is like the January 1st values, and then the 2019 would be the December 31st values, of course. So let's calculate the current ratio, quick ratio, inventory turnover ratio, and days of inventory, receivables turnover ratio, and days receivables, total asset turnover. We want to have the times interest earned, the debt to equity ratio, and the total debt ratio, the equity multiplier. Then we'll calculate the profit margin, return on assets, and return on equity. So you also have the information that there are 1,000 shares outstanding. So the company has 1,000 shares, and the current market price is $500 a share. So we're looking to calculate earnings per share, the price earnings ratio, the book value per share, market to book ratio, and the dividend payout ratio, as well as the retention ratio. So let's start off with the current and quick ratios. So the current ratio is current assets over current liabilities. So that's both current, the name indicates it. So the current assets you can see here, and the current liabilities are there. Now, we don't, since we're looking for 2019, and these are both balance sheet data points, we don't have to worry about any averaging. We're just calculating it using the 2019 numbers. So that's, as you can see, the 147,624 over 31. Now the quick ratio, you remove the inventory, which is the slowest moving asset. You would actually also, in certain cases, you'd be removing prepayments and things like that. But generally speaking, for the purposes of what we're doing here, you would remove the inventory out of the current assets. So that would give us the 750 here that we're removing, and we have our quick ratio of 3.59. So now we're moving on to efficiency ratios, and here we start with inventory turnover ratio. Now the inventory turnover ratio is calculated as the cost of goods sold divided by the average inventory. For any of these, whenever you have a turnover ratio, whatever it is that we're turning over will be on the denominator, and what's on the numerator has to do with what causes the turnover. So inventory, when it's sold, becomes cost of goods sold. That is that number. So this is how you'll see the parallels here. Now, because this is an income statement amount on the numerator and a balance sheet account on the denominator, we usually will use the average values for the balance sheet amount for the reasons stated previously. So here we have the cost of goods sold, 435,500, and here we have the average of the balance sheet inventory account. So that's 34,125. That gives us 12.75 times. That means we're turning the inventory around 12 and almost 13 times a year, which means we're doing it more often than once a month. So their days of inventory will be somewhat less than 1 month. We calculate that by just dividing that number, or dividing 365 by the turnover ratio. That's always going to be the case for all of the days figures, and that gives us 365 over 12.75, or just over 28 days. Now we're going to look at receivables turnover ratio and days receivables, also called days sales outstanding. Now here again we have the receivables on the denominator. We're using the average again because the numerator is what is related to the receivables or causes it, and that's the sales. Technically speaking, it would be the credit sales. Now most businesses will have either completely cash sales, like most retailers do, or will have completely credit sales. But just to keep that in mind, credit sales would be the technically correct way of determining this. Now again, we're using the averages, so we have the 650 is the sales, and we're averaging these two figures out, so that's 60,937.5. And that gives us 10.7 times, 7 times. So the days of receivables is going to be somewhat over a month, as we're doing it less than 12 times a year. Now the total asset turnover tells us how many times are we turning over with our sales, how many times are we turning over our assets. And again, we're using the averages here. So here you see the average assets are just a little under 275,000. And so that gives us 2.36 times a year. Now the times interest earned tells us, especially the banks would be interested in that, to say how much are we earning more than the interest. And the earnings is not looking at the net income, but rather the earnings before the interest, because the interest we're paying, the 5,200, will be served or can be paid out of the earnings before interest and tax, or often called the operating interest or operating earnings. So here we have 45,000 divided by 5.2, 5,200, so that's 8.7 times. Now the debt, now we're moving to leverage, that's debt equity and total debt ratios. Now one thing we have to keep in mind is that when we talk about the debt, we're talking about, normally refers not to just the debt, but any other liabilities. So it's total liabilities over total equity, actually. So the equity, you can see the balance sheet is a total of the paid-in capital of retained earnings. So that's these two. That's 151,984. And the debt is total liabilities, as I mentioned. So all we do is we take the total liabilities and equity, subtract that from equity. So that's the 282,000 minus 151. So that's what we put in for the numerator. Now the total debt ratio takes debt over assets. Again, that's going to be total liabilities over assets. So the only thing that changes is the numerator. the denominator, which is the total assets, or total liabilities plus equity, that's the same, and that gives us the 0.46. Now we're moving to the equity multiplier, and that's simply assets over equity. We calculated the value from equity from the last time, so we have the answer here, 1.86. Profit margin, we're talking profitability, so here we're going to use the net income divided by the sales, sometimes called return on sales. So we have 30,628 is the net income, and the sales is 650,000. So that gives us 4.71%. Now to calculate the return on assets and return on equity, the return, of course, again, is a profitability measure. So we're looking at net income. And for the assets, the return on what? The assets. So what's the average asset? Because we have an income statement value on the numerator and a balance sheet value on the denominator. So we're going to use the average again. So the net income is 30,628, and the average assets we're looking at is 275,000. So that gives us the 11.14%. Now the return on equity, we're doing the same thing. Now we're using average equity. So once again, 30,628, and we're going to then average out the equity figures, and that's using all of the equity which is paid in capital plus retained earnings here. And so we end up with 145,542, and that gives us a 21.04%. Now we're talking about market values. They require use of further information, particularly the number of shares outstanding and the market price of a share. So recalling that from the earlier slides, it was mentioned the number of shares were 1,000 and the market price was 500. So the earnings per share is simply the total earnings divided by the total number of shares. So it's earnings per share. So our net income is 30,628 divided by 1,000. So it's $30.63 per share. Now, based on that, we can do the price earnings ratio, which is just the price of the share divided by an earnings per share. And that would then be 500 divided by 30.63 or 16.32. The book value per share and the market to book ratio. For the book value per share, we calculate the actual book value based on the equity on the balance sheet, and we divide that by the number of shares. That would be, at this point in time, the 56 plus the 95. We calculated that before. That's 151,984 divided by 1,000 shares. So each share has a book value of $151.98. We could actually put a dollar sign there. And so now the market to book value ratio is the price per share, the market value, divided by the book value. So that's the $500 we have divided by 152 almost, and that's 3.29. The dividend payout ratio and retention ratio, in this case, will require a little bit of calculation. So the dividend payout ratio says what is the fraction of dividends or fraction of the net income rather that is paid out as dividends. Now the dividends paid must be calculated because they're not provided. But we can figure that out. Why? Because net income is dividends plus retained earnings. So you can see that the net income was $30,000 and the change in the retained earnings was 10,208. So that means 20,419 was not kept. So that is the amount of dividends. So that goes as dividends. The net earnings, net income is 30,000. So we're looking at a 2/3 payout, 66.7%. Now the retention ratio is the change in retained earnings, which is the 10,000 we had, 209, divided by the net income. And that will give us 33.3% or 1/3. Whatever the ratio, one of these ratios is, the dividend payout plus the retention ratio will add up to 1 because every dollar of net income goes into either dividend payout, or retained earnings. Thank you very much for your attention. Hopefully that was helpful as an example.